I have a couple questions based on some of the things you said. A few people really, really want to know where they can get that 2.5%, 3% rate. So which that is not on investment property, that is on primary residence, but which lender they want to know?
There's there's a new lender in Orange County, California. It's called Byand, BYAND.com. Just check out their website, and when you talk to one of the loan officers, tell them I sent you.
Perfect. Let's see. Currently, how many people are currently current on their mortgages versus last year? That's probably a tough one. If you don't know, it's okay.
No, that's okay. Go ahead, Rick.
No, go ahead.
I'd have to pull it up here, but yeah, it's about just looking at the latest Mortgage Bankers Association numbers. Where is that? Sorry.
They're up compared to last year. Both delinquencies and defaults. They're not up as much as you'd expect. I'm stalling while Daren looks for the actual number. But
yeah, it's for
exactly how we used to work together. I'd say a bunch of puffy stuff and Daren do all the work. It was a great relationship for me.
I'm having flashbacks. Yeah, it's 4.36% overall delinquency. That's not just seriously delinquency as of the first quarter of 2020. That is up quarter over quarter, which is strange because you typically do not see an increase in the first quarter in delinquency from the fourth quarter. Still down 1% from a year ago, where we see, so that conversely, that means, to answer the question the way it was phrased, is 96% of folks are still current as of the end. And of course, this is as of the end of the first quarter, before really most of the stuff hit. The one thing I wanted to bring up with Rick, one of the things what Rick is saying that ties into this question is, if you look at the FHA loan delinquency rate, it's at almost 10% now. There was an uptick in the first quarter, 9.69% delinquency rate. And that's up 16% quarter over quarter. It is up 9% year over year. And actually, if you look at the fourth quarter of 2019, long before anybody was thinking that coronavirus would be an issue, the FHA rate had already begun to tick up. And that's something we were predicting. Hey, this is a weakness in the market. It's no, it's no subprime loan crisis, but that is that was going into this a weakness in the housing market. The housing market, I agree with Rick, was very strong overall, but that was already a weakness. And I think that's where those FHA borrowers are the most susceptible to all of this.
It's kind of
is FHA share market about 20% overall?
It's actually closer to 15 to 20% in that range.
So just again, framing the dilemma, because Daren's right, and if you look at the forbearance numbers, the highest single group of borrowers in forbearance are also FHA borrowers. No surprise there, but you're talking about 10% delinquency in 15% of the market. So there will be some areas of weakness. One area Kathy and I talked about is people that have invested in rental properties for Airbnb. I think that's going to be an incredibly vulnerable market segment for at least the next year and a half. If you know somebody who's bought 10 properties and leveraged it 90%, and getting absolutely nobody stopping by the house to rent rooms, there are going to be some properties for sale pretty soon. So there are going to be pockets. There are going to be parts of the market that are more vulnerable than others. And
we have a friend in that situation right now. Yeah, he very, very confident about 3 months ago, and not so much today. Yeah, they way overbought. Big, huge place that was for big events, and not only did the events go, but the tourists. So pretty tough. Okay, well, people do want to know. So what we do know is that the government is coming in really strong to help tenants, to help homeowners. So it's in the residential 1 to 4 unit area. Now let's talk about anything outside of that. The commercial space or Or
Go in a commercial space, you're on your own, babe. It's nobody cares about rich business people, right? Even if they're not really rich business people. There are limited protections for landlords, even at the smaller level. If you're a single family rental owner and you have a Fannie or Freddie backed loan, you do have some forbearance provisions. That same bill I was mentioning in the state of California actually does protect landlords in that smaller category, but requires them, if they get forbearance, to pass along the forbearance to their renters. But I'm not aware of any significant government activity that's set up to help the retail sector, the office sector, the hospitality sector, the industrial sector. My understanding is they really are all on their own. And for your investor listeners and viewers today, there definitely going to be some opportunities in, for example, the hospitality market. Daren, well, actually, this was on the commercial side of the auction business when I was at auction.com, but a lot of small investors buying limited service hotels, your smallish hotels in various towns, and were leveraged. When hotels are operating at 10% capacity, there's a question as to how long those hoteliers are going to be able to keep their finances in order before they have to bail. So I think that market's going to be coming back slowly. I think you're going to see a shift in office behavior. Google's already told all of its employees to stay home through the end of the year. Twitter did the same thing. So when you have these big tech companies who usually have, enormous office complexes, all of a sudden realizing that maybe that overhead is just kind of wasted money, I do think you could start to see a decentralization movement in the office world, where businesses realize they can pay lower salaries to somebody in Omaha than they are in New York City. And the office costs are lower and the productivity is equally good. And in some cases, even better, because now you're covering multiple time zones. So I think there's going to be a lot of changes in the commercial market. I'm candidly a little more concerned about the stability of the commercial market than I am the residential market, because there really aren't any government programs or industry programs to help building owners and business owners. And I think you're going to see some retailers and restaurateurs go out of business that were already on the edge before they lost 3 months of revenue. So it could be, as the old Chinese curse goes, interesting times in the commercial market.
so if one were to open a real wealth fund, it might be it might be in that commercial realm. Yeah,
But it
interesting.
might also have to be, it also might have to be money with a long horizon, because as I said,
Right. Yes.
if you're buying something in hospitality, the airlines are already predicting they're going to have a horrible year in 2021 because
Right.
people will be reluctant to travel. So and I think business travel will probably come back before pleasure travel. And when the airline attendants union, the flight attendants union, put out a press release asking people not to travel for pleasure until further notice, that kind of tells you what the mood of the industry is these days.
Yeah. I mean, the only thing that would really change that is if, obviously a vaccine can't be made overnight, but if there was some discovery that you could prevent even getting this disease, that could change things overnight, I would think. But
The president has a couple suggestions already.
well, we've all heard that, but I heard a lot of those suggestions far before he said it. So, from local doctors, there's a whole lot of conversation there on my Facebook. If you really want to see the controversial side of me, go there. But we will be hiring, a director of commercial real estate at some point for that very reason that you said. Okay, let's see. You already talked about the vacation rentals. I think this is going to be an amazing time to be creative, because, and Daren, we'll want to be getting updates from you on when you do start to see an uptick. Would it be on higher end homes or certain markets that are more affected than others? I mean, are you seeing anything like that now?
Not on the foreclosure auction side yet. We're not seeing the uptick, but what we are seeing is that there's a lot of interest in as I mentioned earlier, on the online foreclosure auctions from investors. I mean, I think the feedback we're getting from investors when we look at their behavior on our site, as well as surveys we've sent out, is that yeah, they were scared for a couple weeks there, but they have bounced back pretty quickly and are buying pretty aggressively again. In our space, we saw just at the last week of April, a 9-week high in the number of bids per property on those online auctions. And the sellers are realizing this too, and it's a good time to sell. I think this is true on the retail side of the market too, but the banks and servicers who have inventory that's already foreclosed, and particularly applicable right now if it's vacant inventory, which 60% of those that are selling on our site right now are vacant. So that takes out the risk element of having a tenant to deal with when you buy that property. But they are realizing now is actually a good time to sell because you don't have a lot of inventory to compete with, and you have strong buyer demand. So, parts of you were talking about Birmingham, and I do have this broken down by city here in terms of some of our numbers, but just to use Birmingham as an example, because you mentioned it, is and this is looking at for April, the month of April, we're showing the average winning bid on properties that we auctioned off in Birmingham in April was just under $50,000, $49,745. We were getting now the buyers were still getting good deals by one way of looking at this in terms of, we look at the average price to the seller's reserve. So the bank says we want to get X percent, and we want to get X dollars out of this property. What percentage of that it actually ends up selling for? And in Birmingham, it's in April, the property sold at 96.5% of seller reserve. So anything under 100% means that sellers are getting a little bit of ground, and buyers are maybe getting a little bit of the upper hand there. But overall, we're seeing that price to reserve right at 100%. So sellers are getting right about what they want for their properties when they're selling them with that reserve. So yeah,
Amazing.
I don't know if that answers your questions, but we're seeing that strong demand, and there's certainly parts of the country where you're consistently can find inventory under that 50,000 mark, at least with the online auctions, which may be surprising to some people. And there's certain parts of the country where sellers are more willing to give a little bit on the price as well. Even like I was looking at Seattle here, which is interesting, a 91% price to reserve there, which is on the lower side of what we see.
Yeah, it's shocking.
It could be a little bit of unrealistic pricing too, as people expect bidding wars on properties. You certainly see that in traditional residential retail sales as well. One indication, Kathy, that we might be seeing the market turn a little bit is that all of the major iBuyers have announced plans to start purchasing again. Some faster than others, but Opendoor, OfferPad, Zillow, Redfin have all basically said, okay, we're getting back off the sidelines. It'll be interesting to see what their offers look like as they come back into the market, because price certainty is really, really important to their business models. Last thing they want is to have a whole portfolio of overpriced properties if the market's going down.
Right.
But that, to me, is at least an indication that there's some confidence in the investor community that there will be, enough transaction volume, enough demand to facilitate things. One thing that your crew probably needs to be thinking about, at least from my perspective, I believe there's going to be a lot of rental opportunities coming out of this crisis. I mentioned earlier that the job losses have disproportionately been among the renter community. Well, a certain percentage of those renters at some point wanted to become homeowners. And maybe some of them wanted to become homeowners pretty soon, but now we're going to have to spend more time getting their financial house back in order before they're ready to buy. or maybe have been laid off for 6 months, and a lender will be reluctant to give them a mortgage until they have a little bit more indication of job stability this time. So I do think a lot of those people are going to be looking for rental properties, and whether it's single family rental or some sort of, you know, duplex or triplex or whatever kind of plex you want. I do think you're going to see a little bit of an uptick in rental demand as we get through the end of the pandemic, maybe more than we've projected. And the multifamily builders are getting ready to put a lot of inventory in the market this year, but there don't appear to be a whole lot of projects in place for continued levels of inventory additions next year. So again, there could be some opportunities for people looking to buy and hold as opposed to fix and flip.
Yeah, we're seeing it too. Just like in our network, if you talked to me in the middle of March, you would have probably seen me cry a lot. We did not know what was happening, but we kept on top of the property managers, and they came up with really great ways to make it to help their tenants be able to pay by offering them, you know, ways to, like, here's the stimulus and here's some job openings, and just supporting them. But even so, we've seen more rental applications than ever, and you know, people staying longer, higher rent collections. So it's been really surprising to us too. What were you gonna say, Daren?
That's fascinating. Yeah, just to kind of reinforce everything you guys have been saying, when we surveyed our buyers in April after the pandemic, the ones that were the most confident, you know, and that was a few weeks after the shock and maybe had worn off, but the ones that were most confident were those employing primarily employing to buy and rent the single family rental strategy. Those 64% of those said, hey, we're actually planning to either at least keep our acquisitions the same or even increase our acquisitions going forward after this pandemic, where it was the rehab and renovate, fix and flipper type audience that was on the other side of the coin. Only 43% of them said they were planning to increase or keep their acquisitions the same. And so that, I think that tells you there's a lot more confidence in that investing model in this even in this kind of turbulent market environment, given a lot of the things that you guys just said.